Well, good morning, traders, and probably the highlight in the overnight session was the budget. I'm not going to go into huge amounts of depth. There's been enough ink that's been spilt around that. But I will say the market reaction has been fairly tepid. We haven't really seen any major moves in the Australian dollar. In fact, that's traded in a range of 73.29, which was the low. It got up to 73.67 as the high. So a fairly tight range coming through. There's been no propensity to push the Australian dollar around, even though I think at the margin the budget is really going to give the Turnbull government somewhat of a tailwind. I can't see that hurting his ratings in any shape or form. It's expansionary, it's fairly conservative. The growth numbers, the real growth numbers at 3% through 2019 to 21, in some people's eyes are fairly attainable. They've upgraded nominal GDP for this year and next year to 6 to 4% respectively. And I think ultimately, there's going to be enough spending measures in there. There's going to be enough revenue raising measures in there, which is going to ultimately leave the credit rating agencies in no doubt that the Australian credit rating should be kept at AAA rated for here. And the market will like that situation there as well. Of course, the big talking point yesterday was the bank levy. The bank levy in itself at $6.2 billion over 5 years is expected to hit earnings by average about 5%. To the banks and maybe 1.5% to the EPS for the overall benchmark for the ASX 200. The eyes of the market now is really focused on the banking sector. That had the biggest fall yesterday since June 2016. So whether or not we're going to see a bit of stability coming through there today and maybe a bit of a rally. I see no real reason, no real catalyst to be buying the banks in any kind of great shape here. I still favour buying downside, buying a dip in these kind of banks, but I wouldn't be expecting any kind of major moves today. But I think ultimately the eyes of the market is now what happens to the banks, whether or not they look to defend those net interest margins and actually whether we see a repricing of their mortgage rates coming through, perhaps 15 basis points apiece. That's something that we're going to be looking for just to try and address the potential hit to cash earnings that we're going to be seeing through the levy that we've been seeing there. So that's the big one there today. If we look at the mining space for the Australian market today, well, I think the spot iron ore price was up 1%, but there was some really strong moves coming through the iron ore complex, the bulk commodity complex. We saw really nice upside in iron ore futures, rebar futures, coking coal futures, and if you look at BHP's ADR this morning, it suggested that the stock should open on the front foot quite nicely. Vale, the US listing had a decent gain as well. So, I think we are looking for some modest outperformance from the mining space. I think BHP 1% or so would be a realistic open, and so mining stocks should do okay, even though they were down in the US listed, just based on what we've seen from that ADR there from BHP. Energy stocks, no real clear lead through there. I think what's been interesting is we've seen the API number there, the American Petroleum Institute, coming out of their weekly inventories, which of course are a precursor to tonight's Department of Energy, the official numbers there. Now we have seen a massive drawdown, over 5 million barrel draw in the crude inventories, but at the same time we've seen a 3 million barrel build in gasoline inventories. So one suspects at the margin that's modestly positive of the barrel. Everyone's been focused more intently on the gasoline inventories as opposed to crude inventories because that's seen as more of a leading indicator. So there obviously we could see some sizable upside to the consensus number for tonight's Department of Energy gasoline one. So I wouldn't be surprised if the market does expect some downside risk to those numbers, especially the gasoline one there. So 12:30 is the inventory numbers there. For people who are trading oil, keep an eye firmly on that as well. I think throughout today, whilst we are expecting the market to open on a positive footing, the SPI futures closed up 19 points. I think we need to keep an eye on the Chinese CPI and PPI numbers at around about 11:30. The market is looking for a slight increase in consumer price inflation, but a fairly punchy decline in producer price inflation down to 6.7%. Now, I think if it goes much lower than 6.7%, it'll probably fuel fears that we are seeing an economic slowdown in China, the idea that the government is deleveraging in various asset classes and we're seeing a credit slowdown, and that's going to be perpetrated by this PPI number there. So I think that's definitely worth a look in at 11:30. So all in all, some interesting factors that are coming through. The S&P did hit a new all-time high, although couldn't sustain that 2400 level. But a fairly drab affair there, but a lot going on under the surface and still good opportunities for traders to focus on.